Welcome to today's episode of Positively Geared. Good to see you, Lloyd.
Hi Alex, good to be with you again.
So today we've got another special guest. I think we've become really accustomed, Lloyd, to saying special guest, but we've had so many great guests now over the past several episodes we've been doing, in fact, the whole series. But today's going to be a very, I think, educational episode, and both of us are even going to walk away with some possible new insight. I'd like to welcome John Lindeman, the leading property market analyst of Lindeman Reports. Welcome, John.
Thank you very much, Alex, and hi there, Lloyd. And
Good to see you, John.
Welcome, everyone.
So, John, there's a lot to talk about, but I think we might start from the beginning. We spoke very briefly off air about your story. Obviously, you've been in the game, as you described, for too long now. But life before getting into market analysis, what did that look like, and what sort of drove you to where you are today?
Yes, I have been involved in property analysis and also investing for quite a long time. I started purely by accident. It was because I bought my first house, was in Melbourne. I'd moved to Melbourne and I was able to buy a little terrace house in Hawthorn, and I thought, this is a place to live in. I didn't think of it as an investment at all. But within 4 years, it had doubled in price. And I thought, wow, this is the way to go. I'm going to do this again. So I sold that property and bought another one, this time around the Bayside area of Melbourne, in a suburb called Mentone. And I thought it would double in price over the next 4 years, but it didn't. It actually went backwards in price. And I came away losing, a lot of what I'd gained in the first purchase. I was very lucky that I did that round the way that it happened, because if I'd bought that Mentone house first, I'd probably be a retired school teacher now without any properties at all. But because of the first property purchase, I realised that markets could actually double in price in a few years, and I had to find out how the market worked. So that's what started me on my long journey of learning about the market and how to profit from it.
Lloyd, there's obviously just straight there some parallels between your sort of story too, in terms of the first purchase ended up blossoming into this, fast forward 20 years, and a big portfolio of properties, a successful business, and obviously Positively Geared, the book which we're discussing today.
Well, absolutely, Alex. And I think, the first property I bought was a one-bedroom unit in Rockdale in Sydney, and it was actually to live in as well. Didn't even think about investing at the time. And I was a school teacher at the time, but I wasn't quite as lucky as John, because my property didn't double in 4 years. It actually probably stayed still, because I had actually bought at probably at the wrong time in the market, just post 2000 Olympic Games boom, and the market was just starting to sort of go backwards a bit. And look back now, it's actually tripled in value since then, but that took quite a bit longer. But I guess subsequently, other properties I'd bought that did start to get a lot of growth, and I sort of learnt as I went, and also got into other strategies in terms of being able to manufacture equity in properties as well.
John, what I find absolutely astonishing and remarkable is your accuracy rate of 90% throughout your reporting. That's very, very impressive. Is there a special formula to arrive to that? Obviously, experience would be a big part of that. As you mentioned, making a mistake your second time around as opposed to your first probably was a good way, in the sense that you got a taste for what could be achieved. But then you also very quickly learn that it's not as simple as just buying again every 4 years, as property doesn't always work that way.
That's right. And what I did was I decided to learn professionally about how the market worked. So I got a job at the ABS, researching, that's the Australian Bureau of Statistics, researching the property market. And I came across a system of analysis called trend analysis, where you look at trends rather than just the basic numbers day by day. And trends can tell you which way markets are moving. And I thought, well, you could apply that to the property market just as easily as you could to shares or gold or commodities. So I started doing that, and then I became head of research at Residex, which was a property data provider, one of the biggest at the time. And there I then applied that to generating a database, a massive storage unit of data about the market, so I could see how you could then trend the data. After I left Residex, I built my own database and used all of the leading indicators like sales, listings, rental vacancies, vendor confidence, a whole lot of numbers, put them all together and applied them to each one of the 15,000 suburbs and towns around Australia for all different types of property, and then worked out how these trends played out in reality over time and how you could predict the market. So it's taken a long time to get there, but that's how I got to the 90% accuracy rate in terms of which way markets would move.
And for a lot of mum and dad investors, or people really early into their investing journey, I'm sure a good part of them will be listening to this episode. What are some of the key indicators that they should look for in terms of being able to not just look at beyond trends, but performance over maybe a 5 to 10 year period?
The three main things you look for in terms of which way prices are likely to go. The first thing is the population increasing in that area, more people wanting to move in. And the reason for that is that everybody needs a place to live. So if you've got people coming into an area, you've got more demand for housing. The second thing is, are the banks willing to lend into that area? And right now, with pandemic being what it is, the banks are very, very cautious about lending into certain markets, certain types of borrowers. Much easier if you work in, say, gambling or retail, you might get a loan much more easily than if you work in tourism or accommodation. So that's the second thing. And the third thing is to look at whether there's an inherent shortage or surplus of properties available. And it's not that hard to do. I mean, the easiest way to do that is simply to go to realestate.com.au and just see how many houses are listed for sale in a suburb, and then do that a month later and see if they've gone up or down, because over time, that's the sort of trend I'm talking about. If the number of properties listed for sale drops dramatically, you know that demand is rising. The same with rental vacancies. It's a very easy way to check that supply and demand balance. So they're the three main things.
Lloyd, is there anything that you'd like to build on?
That's spot on. And that's basically the things that we talk about to our clients and what I mentioned in the book. So I think some of the stuff that we research, obviously, things like what sort of government infrastructure, government spending are going on in markets and stuff as well. But at the end of the day, people need somewhere to live. So if the population is rising, if there's a jobs increase, jobs growth in an area, then for me, that's an indicator that there's going to be demand for housing. So it's a good area to look at. And that can open up a lot of regional markets. So we're not just looking in capital cities here. We've got to remember that there's quite often people sort of they just talk about the property market, but it's actually the property markets. And there's many markets around. As John mentioned, there's 15,000 suburbs and towns around Australia. They all have their own markets, and then there's micro markets. And it's about finding those areas that actually have the population increase and the best growth drivers in place.
It's a good segue into my next question, John, which is, you briefly mentioned off air, there's very different markets. And I think the beauty of having an analyst like yourself in the studio is that we do get the opportunity today to dig a lot deeper beyond, some of these sort of buzzwords in the property industry and investing industry. And market obviously is being one of the main ones. And I mean, market is really a generic term, isn't it, John? There's many types of markets.
Yeah, just as Lloyd said, there are almost every property is its own market, because every single property is unique. It's different to any other one. You might find two houses in the same street that look identical, and yet they'll sell for different prices. So it's very different to, say, shares or other commodities. It's very specialised, very unique in terms of what it offers.
And we've talked about that before, Alex, haven't we? That now you can get into a suburb and get the right suburb, but then you've got to get into the right street, because some streets are going to actually sell for better value than others. And then it comes down to being the right side of the street, or maybe the high side of the street is going to sell better than the low side of the street. So it really does come down to, every single house can be its own market.
John, we spoke about in an investment sense, you get there's also different types of tenants. There's people that rent permanently. It could be seasonal. Does that impact upon how you would produce an analysis on a suburb in terms of its investability?
Very much so. We have identified different types of renters as sort of permanent, seasonal, temporarily or regular. To give you an example, during the construction of the Pacific Highway, which was done all the way north from Newcastle up to the Queensland border, as the highway progressed, as the duplication project progressed, thousands of the construction workers rented in the towns along the way. So what we saw was rent demand increasing dramatically in Taree, and then Kempsey and Port Macquarie and so on, all the way up to Ballina. And rents rose dramatically, and investors made a lot of money by going in there and buying, but it was all temporary. Once the highway was finished, that rental demand disappeared. So you really have to look for constant rent demand. It could be rent demand which is caused by, say, tourism coming in areas, or students that even though the students come and go, there's always a constant demand for them.
I know, Lloyd, you talk about the trifecta, the property trifecta, in terms of the three overall things you want to achieve to know that you're investing well. And Lloyd, you can possibly build on that in a moment. But John, to avoid buying into areas which are a bit more highly leveraged based on what's going on in terms of, for example, infrastructure, they might not be the best investment down the track. Is there something that you'd suggest people listening to should look out for beyond just population and infrastructure if we're to dig a bit deeper?
I think you've got to look at the basic balance of supply and demand in any area. because if there's a surplus of properties, be it for sale or for rent, then there's not going to be any growth opportunities for investors. Again, that's not really that hard to do. If you look at rental markets, I always tell people just talk to some local property managers and say, look, have you got a list of tenants looking for properties, or have you got a list of empty properties waiting for tenants? Because the first one is good and the second one is very bad. So a little bit of research can answer a lot of questions.
I find also that asking agents if they've got a list of buyers looking for certain properties in areas where I know there's a shortage of properties available, and that gives a bit of an indication of demand there. But Alex, getting back to the trifecta, yeah, so we're sort of looking for growth and creating some instant equity there, and the cash flow. So they're kind of the three things I like to look for. But John, I wanted to ask you, I often talk about when you invest, you need to look into areas that have several pillars of growth or lots of industries. In your forecasting, how have you sort of seen markets like, say, mining and tourism over the years?
Well, I think mining, it's got a bit of a bad press since the ending of the mining boom. That was always going to be a speculative type of investment. The huge rises in price in Moranbah and Port Hedland, the huge rents that people were getting. When we looked at those markets back in 2012, I could see that a crash was imminent. And the reason we could do that was all we had to do was look at the number of advertised rental vacancies. It was that easy. We saw the rental vacancies rising dramatically, and that was an indication that miners were leaving town, that the work was winding up. And so that increase, when I told people, I said, look, the rental vacancies in Moranbah are rising dramatically. It's time to sell. And they said, oh, but rents are still going up. Prices are still going up. And I said, yes, but they're called lagging indicators. They tell you what's already happened, not what's going to happen. Rental vacancies tell you what's about to happen. So in mining towns, that's what you look out for. With regard to tourism, very different dynamics, but what I look for there is, where are people likely to come from? Now, in the past, we've had a lot of tourism from places like America, and they look for different things than, say, Japan, where tourists might look for golf courses and trout fly fishing. Then the Chinese have started to become tourists, and they go for pristine natural areas, looking at our wildlife and so on. So when tourism re-emerges, when the borders are opened, I think what we'll be looking for is, where are people coming from? Because that'll tell you which areas are going to boom tourist-wise.
Obviously, John, with COVID-19 at the moment, tourism, at least at the moment, seems quite slow. Not even all the borders are open up within Australia at the moment. What do you look for in terms of maintaining the level of accuracy you have through a period like this, which is breeding a lot of uncertainty?
Well, you can quantify the tourist numbers and migration numbers. At the moment, they're pretty much down to zero, and the impact that's going to have on those areas, which I think is pretty negative. So it's easy to say these are the areas that are going to suffer, and in particular the inner urban unit markets of Sydney and Melbourne and Brisbane are at risk of price falls. But elsewhere, I don't think they have such an impact. Then once the borders are open again, it's a whole different game, and we'll be looking at where people are likely to come from. To give you an example, we had that recent terrible crisis in Beirut with that huge explosion. I think that once the borders are open, we're going to get a massive number of people coming here from Lebanon. Depending on whether they're Maronite Christians or whether they're Sunni Muslims, that will determine where they decide to rent in Australia. We'll get a lot of people from Hong Kong. And so again, they might choose totally different areas to rent, but where they go, that's where the rent demand is going to rise dramatically.
In terms of Australia as a country, and the government obviously did a lot during the Royal Commission on Finance 2 years ago, had to put some measures in place. We did see the market over sort of 14 to 16 into 17 really start to get away from a lot of people. Lloyd, I know you're of the opinion that obviously the government's not going to just allow a mass exodus of properties hitting the market and a dramatic crash. John, what can you sort of build upon that thought process in terms of, I know you mentioned the term immunity.
Yeah, there is a lot of markets in the property market which are pretty much immune to any sort of downturn. I think the middle part of the market, which is around the median price suburbs, a bit above and below, the banks are quite willing to lend to people in those areas. They've got good credit history records. They've got equity in their properties. They're able to upgrade fairly easily. So I don't think it's going to have any effect on the major part of the market, and it might have a bit of effect at the top end where you find people downsizing because their superannuation or share market returns have dropped a bit and they might buy a smaller home. But I don't think it's going to have a major effect. I think the biggest effect, apart from the downturn of the inner-urban unit market, is we could see a lot of regional growth. I think a lot of people will start to look at regional areas much more positively as being clean, green and COVID-free, and they can work from home. So as long as they've got good internet access, they'll be able to do that. So I think we'll see an exodus to some extent of people out of cities into regional areas.
I think that with more people working from home, they'll definitely be moving out into those outer suburbs and regional centres because it's more affordable. And it's also those lifestyle opportunities I think that people will crave. And that'll, I think, put upwards pressure on some of those prices as well.
John, for people early into their investing journey at the moment that are listening today, there's obviously a lot of apprehension because of COVID in terms of, is now the right time? Lloyd mentions in his book, Positively Geared, that, there's never a bad time to buy property. It's always a question of where. And I'm sure, through your reporting, you can obviously back that statement. There are markets, as you said just now, that will absolutely profit or benefit from what we're experiencing at the moment. And I think, particularly along the lines of decentralization, which you've touched on, people are going to gravitate towards other areas on the basis that they don't have to travel into town. Back to my point, for people that are maybe on the fence at the moment, what would you suggest, and not just on an analytical basis professionally, but through your own personal experiences through property, what would you suggest that they look at doing in terms of getting started, knowing that property is a long-term investment strategy?
I would say to anyone in that situation, don't hesitate. There is no right time, as Lloyd said. It's the right property. That's what matters. And so there's always going to be the right property to buy, which will go up in price, that can be positively geared. So, don't hesitate. But make sure you buy the right property in the right area. That's going to be the trick. And there's lots of areas around Australia which have got good growth potential right now and will continue to do so.
And how do you differentiate between, obviously a primary place of residence is more of an emotive decision, but when you're trying to find areas to buy outside of Sydney, obviously the first thing you should probably do is call Lloyd, because he's the absolute expert in the field. Is there something that you have used as a system or a process to identify beyond? Because obviously when you're analysing 15,000 suburbs, there's probably a high percentage of them that you identify could work as viable investment opportunities. How do you sort of dig deeper from that point onwards?
So when I've looked at the different ways you can profit from property investing, there are so many different strategies that some will suit some people, like renovation or development. Other people might go into high cash flow or Airbnb and high res and so on. So I think you've got to look at your own, in terms of property investing, what you want to get out of property investing, and that will largely determine the location and the type of property. So in my case, I was heavily into renovation early, and I bought properties, renovated them. Once I'd worked out how the market worked, I realised I didn't really have to do that to make a lot of money. I just simply had to buy the right property in the right area. And to give you one example of that, there's a little town in southern New South Wales called Hay, which has about 4,000 people. All the farmers in the area were turning to cotton farming, and because it was the best cash crop available to them apart from marijuana, but it was legal. They all started growing cotton, but there was no cotton gin in town. And so the cotton cooperative said, we'll build a cotton gin. We need 170 people to come in and build it. I heard this on the ABC News. I had a look at the number of rental vacancies on realestate.com in Hay, and guess what? There were none. And then I looked at the number of properties for sale in Hay, and there were 3. And I thought, if 170 families are going to move into Hay to build this cotton gin, rents are going to go through the roof. Then investors will find out and they'll start buying property to get 15, 20% yield, and prices will go through the roof because there's not enough properties for sale. Simple combination. What it did was it resulted in prices doubling in 7 months. The best ever result I've ever had. I don't think I'll be able to repeat that. I'd like to, but it's the sort of thing you can achieve if you buy in the right area at the right time.
I actually remember that. And Hay was actually the cheapest market, I think, in the whole country to buy in. I remember you could buy houses for, like, a good house for 30 or 40,000. You could buy a block with something on it for like 10,000.
Seems unheard of.
Yeah, it was quite something, and we've never repeated that success. But we've looked for similar types of areas that have got a lot of growth potential because of something changing in the area that's going to bring people in.
Where did you then take that? Is that something that you've kept as part of a portfolio? Was it something that you eventually decided to move on? Walk us through that decision-making process.
I think it's the best property investment strategy that you can have is when you're fairly young, so more of Lloyd's age. What you're after is as much capital growth as possible. So you start off getting as much capital growth, and if you can do that with positively geared properties, if you're clever enough, that's great. But the idea is to manufacture or get as much equity as you can, because then you can borrow more and you can increase your equity that way. When you're my age, you're after the opposite. You're after cash flow, because it's no benefit to me to buy properties for growth because I'm leaving the money to my kids or grandkids, no benefit whatsoever. But if I'm doing it for cash flow, that is a benefit. It's money to live on. So I think it changes over time. You start off going for growth, for equity, build up a portfolio, and then gradually move over to high cash flow generating properties, which is what we've done. So now we've got properties in Queensland, New South Wales, Tasmania, all of them generating positive cash flow.
Lloyd, you mentioned in the book, positively geared, really the only time, if you strategize well and do things right, that you need to save a deposit's that first time, isn't it? And John, obviously what you've just explained is a great way and great example of, identifying markets that are not in your typical Sydney metro or Melbourne, which, a lot of mums and dads typically gravitate towards because they live up the road. It just really solidifies everything that you've talked about in the book, Lloyd, isn't it?
That's right. If you buy in the right location and it doubles value that quickly, then that's equity you can use to get into your next deal. But so when you think of people on their regular income who are just trying to save for a deposit, that can take quite some time. So buying a property and then trying to save up for the next property and trying to get a deposit together in the next 4 or 5 years, that's a very slow way of doing anything. And really, you can't really save your way or build up wealth by saving your way that way. So you really need to use equity. So you're buying properties in the right location that are going to get the growth. But also, depending on your strategy, and what John says is right, it depends on what age you are, what part of your journey you're on. But you need to really look at how you're going to create that equity, whether it's through growth, whether you're going to manufacture that equity.
So, John, on that note, obviously your second property purchase, the experience wasn't as positive as the first one. What were the main learnings you took away from that? And what did you then use beyond that to sort of make better decisions in the future?
I guess the main takeaway for me was that I really didn't know the property market at all. I'd made a really bad decision. I was determined never to do that again, but I really had no idea what was out there. And so I bought every book I could find. Unfortunately, Lloyd's Positively Geared book wasn't available at the time. I don't think Lloyd was born then, but it was quite a long time ago. But I read every book I could find, and they taught me a lot about the market, but none of them showed me how the market worked. So then I went to seminars and expos and trade shows and boot camps and so on, and I learned a lot more. But again, not one of those presenters told me exactly how it worked, and I thought, I've got to figure this out for myself and make that a sort of bit of a quest, if you like, which is what I've done.
Let's fast forward from purchase 2 to purchase 3. What changed, if we really break it down, in terms of where you looked, all the decision-making process behind that, if you can sort of go back into that headspace at the time?
When I was still learning at that time, and I realised I didn't know much, I did know one thing, and that was you can improve the value of a property through renovation. And it's one of the few assets where you can do that. If you own shares in Woolies and you go and paint the front of Woolies, it's not going to improve the value of your shares. You'll probably get arrested. But you can do that with property. So I thought, well, that's something I can do while I'm learning. I was going to university, and so what I did was I bought a property and renovated, and I've stuck to that. While I was learning how the market actually worked, I thought this is a good fallback, and it does work as long as you know enough to buy in an area where property prices aren't actually going to fall, because that obviously lessens the potential for profit.
Manufacturing equity, Lloyd, is one of the key points in the book Positively Geared. Beyond basic renovations, what are some other ways that people can manufacture equity? And it might not just be with one property. Once you've obviously got a portfolio built, Lloyd, it gives you the flexibility to sort of work the numbers, doesn't it?
Yeah, absolutely, Alex. I think development is obviously a good one. So what I do a lot of is duplexes. So getting your block of land and putting a duplex on it and subdividing it. The other thing also is general subdivision. So you get a house on a big block and doing a subdivision there, subdividing maybe the back of the block, and then you can actually maybe sell that block and get the profit on that. Possibly you can build a house on that and then sell that. But that's, another way of manufacturing equity that way.
What's your experience, John, with subdivisions? Have you been intimately involved with subdivisions in the past? Have you embarked on bigger developments beyond your sort of standard residential Torrens title home?
Not myself, but I do run a number of education programs and a mentoring program. And one of our students had bought a property this was in Adelaide. She was going to do a development there. Now, because of our research side, what we did was we said, well, you've bought this now, but do you realise that prices are likely to fall in that area? So what she did was she sold the property with plans and permits approved and then sold it to somebody else who was going to do the development, but they never did because prices did go and it became an unprofitable exercise. So the system I have enables you to work out whether or not a development is feasible, whether it's going to be more profitable or less profitable based on the way that prices are likely to go. But I haven't actually done that. My research is a full-time exercise, and so I haven't got the luxury of, I wish I had the time to do it, but I just haven't got that.
So, John, I'd love for you to shed some light on, there's a bit of a narrative amongst a lot of mum and dad investors, which is that, if you're looking to invest in an area, you buy the property down the road or in the suburb 5 or 10 kilometres away. But that's definitely not the case, is it?
It's very much not the case. It could be the worst thing you do. And there's a very good example of this. One of the things we do when we look at potential areas to buy property is you look at the rental yield and how high the rental yield is. And it's a good initial indicator. And so the highest rental yield in the whole of Tasmania was a suburb of Hobart called Risdon Vale. It's on the eastern shore. It's an outer suburb of Hobart. And I thought, why on earth would this place have high yield? Maybe it's because prices have been falling, because that can push up the yield. I looked up, hardly any rental vacancies. Prices hadn't been falling. So on our next trip, we do a lot of travel around Australia looking at, or we used to before the outbreak of COVID, looking at potential areas. So we went to Risdon Vale. This is the most depressing suburb, and I hope none of our listeners living in Risdon Vale, I don't think you are. It's a pretty,
apologies if you are.
Apologies if you are. Pretty ordinary suburb, and we thought, why would this have such high yield? And then we came across this huge prison, and it's the maximum security prison for males in Tasmania. That's where all the bad offenders in Tassie, they get locked up in this prison in Risdon Vale. Now, can you imagine a worse place to buy a property? There's, razor wire fences, there's howling dogs, there's searchlights at night. You think, there's no way I'd ever buy a property. But remember, you're not going to live there. It's somebody else wants to live there. And who is it? In this case, it's all the wives and the girlfriends of all the guys that are locked up. And they rent a place in Risdon Vale while their partners are, serving their time. And even families will go there and rent, and they've got in the prison, there's a kiddies play area so that the kiddies can have a little play around while mum's in with dad having a conjugal. So, that's how it works. And so the rent demand is extraordinarily high. And also because of this high, rental yield, it means that investors who are in the know buy properties and get this high yield, and that causes prices to go up as well. So it's probably one of the better places to invest, but it's not the sort of place you'd want to, be in yourself. And the best thing, if I can finish on this note, is that, of course, the fact of it is that the worse the crime rate gets in Tassie, the better rental yields are going to be in Risdon Vale.
Lloyd, have you bought for anyone in Risdon Vale yet?
No, in fact, I haven't even heard of that suburb. So apologies for anyone listening that might live there. But no, I'm not familiar with that area.
Might be one to add to the list for prospective investment.
Or maybe it's got good yields there.
And John, for people that might not be as adventurous to look at something like Risdon Vale, and that's a very good example you've just used as to why you don't necessarily buy the house 2 doors down the road from you. If they were to, let's say you were living in Sydney and you were looking to invest and you identified that you wanted to be in Sydney, and possibly as part of that it means you haven't engaged Lloyd services because he'd probably suggest other areas. Is there something basic or a basic model that you can suggest people follow in terms of where they might want to look at buying?
Well, obviously within their buy price range, which would knock most people out of Sydney to start with. But I'd say that at the moment, if you're looking at what's happening around Australia, I'd be avoiding inner urban units. I'd be looking at the middle part of the market, and that's, of course, $1 million plus properties. They've got the best growth potential, and there's also some growth potential in people downsizing, older people retiring and selling a house in, say, Chatswood or Manly and downsizing to a unit in Queenscliff or Dee Why, something like that. So there's growth potential there, but there's not a lot at the moment. I think it's the regional areas that really hold the best prospects.
Lloyd, obviously we talk about investing in regional areas is a great starting point to eventually get into the capital growth markets of Sydney and Melbourne. What trends have you seen over the past several months in light of COVID?
What I've seen in light of COVID is, firstly, there has not been huge price falls at all in property. Melbourne's had the largest decrease, but outside that, markets haven't done much. But the regional markets have really not been affected much at all. In fact, some of them are going very strongly. There's very good buyer demand out there, and there's still a shortage of stock on the markets. And that's sort of helping keeping prices up as well. But I think, as we've talked about, the last thing the government really wants is a big property crash anyway. So, there's a lot of talk about, when JobKeeper ends in March, whether the economy is going to fall off a cliff and property prices crash and things like that. But I just don't really see that happening. Firstly, I think one thing that hasn't been taken into account is that many businesses, probably most businesses, will get back on their feet. Most people on JobKeeper will actually get their jobs back. So the high unemployment predicted is not really going to become as high as many have predicted. It's probably going to be much lower than that. That, coupled with the low interest rates and the other government stimulus packages around property, I think it's really going to help prop everything up. So I think all can be pretty confident that the markets are going to be still pretty strong and relax about having, there's not going to be any 40% crash in prices.
And it always comes back to the long term anyway, doesn't it, Lloyd?
Absolutely, yeah. So I always think, look at where you want to be in 5, 10, 15 years' time. What are you trying to achieve? And don't get swept away in the hype of the markets of the next 3 or 6 months. And I think, have a read of John's reports and see where he's predicting things to occur.
The other thing too, John, is that, and you have certainly seen this over your time professionally and personally. Obviously, COVID's a very unique. It's not that we have pandemics every 4 or 5 years. But what I think we'll walk away from this experience from, beyond the possible changes to how people work and more the social aspects, is that, a bit like the money markets, when there's a big announcement, or Apple releases a new phone and all of a sudden the share price surges the next day. I think we might see a similar, result once COVID's over, in the sense that people will very quickly adapt. I mean, let's say a vaccine's rolled out tomorrow. It's back to business for most people, isn't it? Life will get back to normal a lot sooner than we think.
It definitely will. And I think Australia is one of the luckiest countries in the world, because we are blessed with a very peaceful nation, and we haven't been involved in wars of our own making. We've been spared all the tragedies that have occurred in other parts of the world. And when these things have happened in other parts of the world, we become the destination. We're the place that people want to go to. So I can see a huge lift in migration to Australia once the borders are open. I think we'll find a lot of people coming here, and that's after the First World War and the Second World War. It was the huge numbers of people who came here that immediately lifted, the market. Prices doubled within a few years. Even after the First World War, we had the Spanish flu, and yet despite that, the fact is that property markets doubled once people started coming here in numbers. I think that'll happen again. I think we'll get a revival of tourism. International students will come back, and our markets will boom like we've never seen before.
So there's a very, very positive outlook. Defies a lot of the small talk that we see in the media. So that's great to hear, John. I think the other thing too is, you look at Australia as a population per capita, and how much space we have geographically. We're actually a very small country compared to other parts of the world in terms of our overall population, aren't we?
We are, but up till COVID, we had one of the highest population growth rates in the world, and certainly in the Western world, but most of that was from overseas migration. So I think that's where we'll be heading once this is all over once again.
And as you mentioned, there's going to be demand for more dwellings, more housing. It's going to really help prop up the housing market and the property market.
I think especially the regional markets, because now you can see during the Great Depression, 2 things happened socially. And one was that overseas migration stopped because there was no work in Australia. The second thing that happened was that a lot of people moved out of the cities to regional areas. So I've looked at house prices, and during the Great Depression, the country house price, average price, was higher than a similar price for a house in Sydney or Melbourne. So people wanted to live in the country. They wanted to get away from the strife and the turmoil and the unemployment. And I can see a similar social situation occurring here. We've got a lot of people coming or moving out of the cities.
Yeah, I agree, John, because I think that there'll be people who are a little bit worried. I think COVID's around for a while yet, and there will be people who want to sort of try to escape that. And generally speaking, it's not really in the regional areas, and people can escape to the country and feel a bit safer there. So I think that's something that will come that we haven't really seen before, or maybe certainly not seen for many, many years.
And that really just underlines the importance of aligning yourself with the dream team. Well, for both your cases, John, having the ability to have access to a service like yours where you can buy these reports, there's obviously a really high degree of accuracy behind them. I think particularly when we do move towards changing times, it's great to have the data to really support your decision-making process. And then, of course, Lloyd, being out in the field every day, being able to help guide people through, big life decisions, which is buying property or investing in property. It's probably more important than ever to have those people behind you.
Yeah, absolutely. Yeah. And I think, like we always say, just have the right advisors behind you, put that right team behind you. And I think adding John's reports to that team, essentially, so you've got a good idea of where you can buy and really think outside that circle. It doesn't have to be those city suburbs. It doesn't have to be the same regional centres you've thought of before. There's a lot of options out there.
John, we're running out of time, but just to sort of close off on today, it's been great talking to you. I can tell there's just so much knowledge and life experience in that brain of yours over the years, and the way that you look at property and identify using, a real analytical process is fantastic. And we haven't really had anyone quite like you on the show yet, so it's been great to have you. Looking back on your career professionally and personally, what do you think are the best takeaway points that you could give to people listening today?
I think the main takeaway points are that one thing I was taught when I was young was that all debt is bad, which I think is complete rubbish. There's good debt and bad debt. Good debt is property debt because you can earn more than what it costs you. That's the first takeaway is don't be scared of debt if it's good debt. You borrow to buy property because it's going to generate more income for you. The second takeaway is don't try and do it on your own because you need the help of recognised experts. And I think from today, what I've seen is that people like Lloyd and myself can work in tandem because what I do is show you where the right areas are and then Lloyd can show you the right properties in those areas. And so one complements the other. And I think that's the other thing I've learned. Don't try and do it on your own because the chances of going wrong are massive.
Yeah, thanks, John. And where can people find your reports or buy your reports from?
We've got a website called lindemanreports.com.au and there's lots of blogs and interesting information there. But also, if you want to buy our reports, you go to that website and that's where you can find them.
Thanks so much for your time, John. It's been excellent.
Fantastic. Thanks so much for joining us.
Thank you, Lloyd. Thanks, Alice.